Before Wall Street, before banks, before money as we know it, there was a temple. A desert sunrise spills over the ruins of Mesopotamia. Beneath the sand lies a forgotten civilization. And beneath that, an idea that shaped every economy that followed. Clay tablets. Cracked, ancient, fragile. Yet carved into them are numbers, names, dates, promises, not prayers, not myths of gods, but debts, older than the pyramids. 4,000 years ago, someone wrote, I lend, I owe, I will repay with extra. That single idea, borrowing with interest, would go on to build empires, collapse nations, and define modern capitalism. But who created it? Not kings, not merchants, not warriors, priests, holy men inside sacred temples quietly inventing the world's first banking system. This was ancient Babylon. Towering walls, bustling markets, and at the center of it all, temples believed to be the safest and most trusted places on earth. People brought their grain, their silver, their wealth, trusting the gods to protect it. And the priests recorded everything, line by line, mark by mark, tablet by tablet. Then came a dangerous realization. Stored wealth just sits, idle and unproductive. What if it could be lent? What if time itself could be sold? A farmer receives seed grain today and promises to return more after harvest. A merchant borrows silver and repays extra after a long trade journey. A surplus becomes a profit. A favor becomes a contract. A promise becomes law. In that moment, interest is born. Not in a palace. Not in a marketplace. But in a temple. And once debt exists, power shifts. Once interest exists, time becomes money. The first banking system was not built with marble halls or steel vaults. It was built with clay and faith. So here's the question. If the system that runs modern finance began inside a temple, does that change how you see money today? Was banking created to help society grow, or to quietly control it? Share your thoughts in the comments. And if you enjoy uncovering the hidden origins of business, power, and innovation like this video, subscribe to the channel, and share it with someone who believes finance started on Wall Street. Because the deeper we dig into history, the more unsettling the truth becomes. Before vaults, before ledgers, before money had numbers attached to it, the world ran on trust. 4,000 years ago, in the fertile river valleys of Mesopotamia, cities like Uruk, Ur, and Babylon rose from the mud brick plains. These were agricultural societies. Barley fields stretched to the horizon. Canals carried life-giving water. Nearly all wealth came from the land. There were no banks to hold savings. No formal loans. No interest rates. Trade depended on barter and personal reputation. A farmer exchanged barley for tools. A potter traded jars for wool. Merchants traveled between cities carrying goods and promises. If someone said, I'll repay you after the harvest, that promise was the contract. Memory served as the ledger. Honor was the collateral. But as cities grew, this fragile system began to crack. Barley was bulky and difficult to store. Grain spoiled. Rats devoured it. Fires destroyed it. Thieves took it in the night. A family's entire wealth could vanish before the next planting season. Silver existed, but it was scarce. Most people lived from harvest to harvest. When crops failed, there was no safety net, only debt and desperation. Trade also became more complex. Barter worked within small communities. It failed across distance and time. A merchant needed supplies now, not after returning months later. A lender wanted proof. A borrower wanted fairness. Without written records, disputes were constant. Who owed what? When was it due? At what value? Trust alone could no longer sustain a growing economy. People hesitated to lend. Merchants avoided risk. Economic growth slowed, not because resources were scarce but because systems were missing. And then there were the temples. In a world without locks, alarms, or insurance, security was sacred. Mesopotamian temples were not quiet places of prayer. They were massive, fortress-like complexes, built with thick mud brick walls, guarded day and night, and believed to be under the direct protection of the gods. Stealing from a temple wasn't just theft. It was sacrilege, punishable not only by law but by divine wrath. This made temples something rare in the ancient world, institutions people trusted absolutely. As trade expanded, citizens began turning to temples for protection, not of their souls but of their wealth. Farmers with surplus barley faced a choice: leave it at home and risk spoilage or theft, or store it inside temple granaries, where it would be guarded, measured, and recorded. More and more people chose the temple. Sacks of grain passed through temple gates. Silver rings and ingots were sealed in clay jars. The priests, once mediators between humans and gods, became something else entirely. They became custodians of wealth. Trained in mathematics, measurement, and writing, priests managed vast storehouses filled with grain and silver. They tracked inflows and outflows. They standardized units of value. They enforced consistency, at least by the standards of their time. But here was the quiet turning point. The wealth inside temple storage wasn't moving. Most depositors didn't withdraw everything at once. Some never returned at all. Over time, temples accumulated enormous reserves, grain that could be planted, silver that could be circulated. And the priests realized something profound. Wealth doesn't need to sit still to be safe. It can be put to work. By safeguarding deposits, recording ownership, and controlling access, temples had unknowingly created the conditions for lending. What began as protection became power. What began as storage became leverage. The temples of Mesopotamia were no longer just houses of the gods. They were becoming the financial heart of civilization. And the world's first banks were about to be born. The breakthrough wasn't metal or grain. It was documentation. Inside Mesopotamian temples, priests began recording every deposit on clay tablets. Barley, silver, livestock. Each item was weighed, measured, and written in cuneiform. A priest pressed a stylus into wet clay, recording the owner's name, the amount, the date, and the terms of return, then baked hard. These clay tablets were not symbolic. They were legally binding. Once baked, they became permanent proof, records immune to memory, argument, or deception. In a society where few could read or write, the temple's written word carried absolute authority. This ended guesswork. For the first time, wealth could be tracked precisely over time. No more disputes based on memory. No more he said, she said. The tablet decided. Each depositor effectively had a personal account. Multiple tablets could belong to one individual, tracking different deposits and withdrawals. Priests organized them carefully, by owner, by commodity, by date. This was not chaos. It was structured accounting. And structure created power. With accurate records, temples managed enormous reserves without losing control. They knew exactly how much grain was stored, who owned it, and when it was due. Silver could remain in storage for months or years without confusion. Transactions no longer needed to happen instantly. Time entered the economy. Behavior changed. People deposited more, traveled farther, and traded longer term. Merchants could leave goods in one city and reclaim value later. Farmers could store surplus without fear. Personal trust was replaced by institutional trust. But record-keeping did more than protect wealth. It made wealth transferable. Tablets could be updated. Ownership could shift. Grain could be reassigned from one account to another without ever moving physically. Value became abstract. Numbers on clay representing goods stored elsewhere. This abstraction opened the door to contracts. Some tablets listed future repayment dates. Others specified penalties for default. A few recorded increased returns over time. Early hints of interest, justified as compensation for risk and delay. The priests were no longer just recording transactions. They were shaping the economy. By writing wealth into existence on clay, Mesopotamian temples created the first financial documentation system in history. One that enabled lending, borrowing, delayed repayment, and enforcement centuries before coins dominated trade. Once money could be written, it could be controlled. And once it could be controlled, it could be lent. Temple storehouses were full. Year after year, grain piled higher in sealed granaries. Silver sat untouched in clay jars. Though this wealth belonged to citizens, much of it remained idle, withdrawn only occasionally, sometimes never. It was perfectly guarded, yet it produced nothing while it slept. That stagnation caught the priests' attention. They understood cycles, of seasons, harvests, and time. And they saw a simple but revolutionary imbalance. While one farmer had surplus grain, another faced starvation before harvest. While one merchant stored silver, another lacked capital to trade. The solution wasn't charity. It was lending. Priests began experimenting carefully. Grain from temple reserves was issued to farmers before planting season. with clear agreements for repayment after harvest. Silver was lent to merchants embarking on long trade journeys, due upon return. Every loan was recorded on clay tablets, specifying quantity, date, and terms. This wasn't generosity. It was structured risk. Time became the critical variable. Grain given today was worth more than grain returned months later. Crops could fail. Caravans could be robbed. Delay carried uncertainty. So the priests added a condition. Repayment would exceed the original amount. Not arbitrarily but mathematically. Barley loans often required repayment of 20 to 33% more at harvest. Silver loans carried smaller increases, commonly around 20% annually. These rates reflected time, risk, and opportunity cost, not moral judgment. Interest was born, not from greed but from calculation. Each loan tablet was precise. Deadlines were fixed. Penalties were explicit. In some cases, collateral was required: land, labor, or future harvests. If repayment failed, the temple enforced the contract. That enforcement changed everything. Lenders felt protected. Borrowers gained access to resources previously unreachable. Trade expanded. Agriculture stabilized. Risk became manageable instead of paralyzing. Most importantly, wealth stopped sleeping. Stored grain moved into fields. Stored silver flowed into markets. Temples transformed passive reserves into active capital, circulating value throughout the city. And the priests became more than custodians. They became financial managers. They monitored balances, assessed risk, and adjusted terms. They learned which crops failed often, which merchants repaid reliably, and which seasons were dangerous. Over time, lending rules standardized. Interest rates stabilized. Contracts became templates. This wasn't chaos. It was policy. Temples now controlled the rhythm of the economy, deciding when to release resources and when to tighten terms. Their records gave foresight. Their authority ensured enforcement. But there was a cost. Debt could trap the unlucky. Failed harvests led to lost land. Missed repayments could bind families into servitude. The same system that fueled growth could also crush the vulnerable. Still, the idea endured. Wealth was no longer just stored. It was multiplied through time. And with that realization, the temples of Babylon crossed a line humanity would never retreat from, turning faith, writing, and surplus into the world's first banking system. Loans were no longer experiments. They became routine. Farmers came to temples before planting season, not to pray but to borrow. Seed grain was issued from temple reserves with clear terms. Plant now, repay after harvest. For many, this meant survival. Without seed, there was no crop. Without a crop, there was no future. Merchants followed. Trade routes stretched across Mesopotamia into Anatolia, the Levant, and beyond. Long journeys required silver to hire guards, purchase goods, and survive months away from home. Temples supplied that silver, recording each loan on clay tablets sealed with official marks. These were not informal arrangements. Promises were formalized. Each tablet listed the borrower's name, the amount, the due date, and the repayment terms. Some included interest. Others specified penalties. Witnesses were named. Collateral was sometimes pledged: land, livestock, or future labor. Once pressed into clay, the agreement became binding law. This was credit in its earliest form. Value was no longer limited to what someone possessed in the present. It extended into the future, into harvests not yet grown and profits not yet earned. Time became a financial tool. And credit changed behavior. Farmers planted larger fields. Merchants traveled farther and faster. Risk-taking increased, not recklessly but strategically. Access to borrowed resources expanded opportunity beyond personal savings. The economy accelerated. Temples tracked repayments carefully. Reliable borrowers gained easier access to future loans. Defaulters faced consequences. In extreme cases, unpaid debts resulted in land seizure or debt bondage. Harsh but predictable. And predictability mattered more than mercy, because predictability allowed planning. As lending expanded, loan templates standardized. Interest rates stabilized. Deadlines aligned with agricultural and trade cycles. Priests didn't guess. They calculated. This wasn't faith-based economics. It was data-driven finance written into clay. For the first time in history, wealth circulated beyond immediate exchange. Grain could be promised before it existed. Silver could generate profit before it moved. Value detached from the present and reached into the future. That was the real revolution. Credit connected strangers, linked cities, bound future labor to present agreements. Civilization no longer moved at the speed of barter, it moved at the speed of trust, backed by records and enforcement, but with credit came imbalance. Those who controlled lending controlled opportunity. Temples became economic gatekeepers. Their approval could launch a business, or end it. Their tablets could secure prosperity, or enforce ruin. Still, the system endured. Because it worked. By formalizing loans, Mesopotamian temples solved scarcity without chaos. They transformed surplus into growth. They turned written promises into economic engines. And in doing so, they introduced an idea that would shape every civilization that followed. Money doesn't just measure value. It creates it. Repayment was no longer enough. As lending expanded, priests noticed a pattern. Returning the exact amount borrowed did not balance the exchange. Time had passed. Risk had been carried. Opportunity had been delayed. A sack of grain today was not equal to a sack of grain months later. So a rule emerged. Repayment would include a surplus. At first, this surplus was informal, an extra portion of grain added at harvest, a small increase in silver after a long journey. But informality breeds conflict. To prevent disputes, temples did what they did best. They standardized. Surplus became policy. For grain loans, repayment was commonly set at 1/3 more than borrowed. For silver, the increase was smaller, often around 1/5 annually. These figures were not arbitrary. Grain spoiled, was bulky, and depended on uncertain harvests. Silver was durable, portable, and less risky. Different assets carried different dangers, and interest reflected that reality. This was the birth of interest rates. Not moral punishment. Not exploitation. Calculation. Time entered the ledger. Every clay tablet now accounted for delay. Longer repayment periods required higher surplus. Greater risk demanded greater compensation. For the first time, time itself carried economic value. This changed how people thought. Borrowing was no longer an act of help, it was a trade across time. Lenders surrendered present security. Borrowers gained future opportunity. Interest balanced the exchange. Priests enforced this balance precisely. Tablets specified due dates aligned with harvest seasons or trade returns. Missed deadlines triggered penalties. Extended terms increased repayment. Everything was written. Everything was measurable. Interest made lending sustainable. Without surplus, reserves would shrink. With surplus, temple stores grew, even after losses. That growth enabled more loans, larger projects, and wider reach. The system reinforced itself. And the economy scaled. Agriculture expanded as farmers borrowed seed with confidence. Trade intensified as merchants leveraged silver for profit. Cities grew wealthier, not by hoarding resources but by circulating them under clear rules. But interest also sharpened inequality. Those who repaid on time advanced. Those who failed fell deeper into debt. A bad harvest no longer meant hunger alone, it meant arrears. Land could be lost. Families could be bound to creditors. Interest rewarded predictability and punished misfortune. The priests understood this danger. Some temples imposed limits. Others allowed delays after disasters. Later, kings issued debt cancellations to prevent social collapse. Even so, the system never vanished. Because interest solved a fundamental problem. It allowed wealth to move forward in time without destroying itself. By pricing time, Mesopotamia unlocked a powerful idea. The future could be monetized. A promise tomorrow could be worth more, or less, than possession today. That insight reshaped human behavior forever. Interest turned waiting into profit. Delay into calculation. Risk into numbers. And once time had a price, every civilization that followed would pay it. Lending only works when repayment is enforced. As loans spread across Mesopotamia, temples confronted a hard truth. Not everyone repaid. Crops failed. Merchants disappeared. Some borrowers refused outright. Without consequences, the system would collapse. So risk was formalized. Clay tablets began listing penalties for default. Missed deadlines triggered fines. Prolonged delays increased repayment. In serious cases, creditors could seize collateral, land, livestock, tools, even future labor. These terms were explicit, witnessed, and sealed. Debt became binding. and binding debt required law. By the rise of Babylon, lending had become central to the economy. Around 1754 BCE, King Hammurabi codified financial rules into stone. Hammurabi's code did not ban lending. It regulated it. Interest rates were capped. Silver loans were limited, typically around 20% annually. Grain loans carried separate ceilings. Predatory terms were restricted, not from mercy but from necessity. An economy buried in debt was an unstable one. The law also recognized reality. If floods destroyed crops or drought wiped out harvests, repayment could be delayed without penalty. Risk was acknowledged and managed. Nature was beyond human control. But protection had limits. When repayment failed without justification, consequences followed. Creditors could seize land or homes. And when nothing remained, the borrower became the collateral. Debt bondage emerged. Men, women, and children could be bound into temporary servitude to repay obligations. Though not chattel slavery in the later sense, it was harsh. Hammurabi's code attempted limits, often 3 years, but the damage was real. Debt now reached into the body. This transformed society. Credit created opportunity but also hierarchy. Those with reserves gained power. Those without became vulnerable. One failed season could trap a household for generations. Still, the system endured. Because it was predictable. Predictability mattered more than fairness. With laws written and enforced, lenders felt safe to lend. Borrowers understood the risks. Disputes were settled by tablets and courts, not violence. Economic activity continued and expanded. Temples and palaces became legal as well as financial authorities. They didn't just manage wealth, they arbitrated conflict. Finance and law fused into a single structure. This was civilization's trade-off. Growth in exchange for constraint. Opportunity in exchange for obligation. By regulating debt, Hammurabi didn't invent financial power. He made it unavoidable. Contracts followed people. Obligations survived seasons. Time itself gained legal weight. Finance had teeth. And once debt could be enforced by law, credit ceased to be optional. It became the invisible structure holding civilization together, strong enough to build cities, sharp enough to break lives. Lending did not remain local. Once loans proved reliable, temples began operating beyond their walls. Grain issued in one city could be repaid in another. Silver borrowed in Babylon financed trade hundreds of miles away. Isolated accounts connected into early banking networks. Trade surged. Caravans crossed Mesopotamia carrying textiles, metals, timber, and spices, almost all funded by credit. Merchants no longer transported their wealth physically. A sealed tablet could represent value stored elsewhere. With records and authority, trust traveled across distance. Babylon thrived. It became a financial magnet. Farmers, merchants, and officials came not only to trade, but to access capital. Temples and palaces issued loans that fueled construction, agriculture, and long-distance commerce. Wealth moved faster. As transactions accumulated, so did information. Priests tracked repayment histories, risky routes, and seasonal patterns. Knowledge became leverage. Terms adjusted. Reliable borrowers received better rates. Risky ventures paid more. Lending became selective, strategic, and scalable. Temples were no longer passive storehouses. They were economic engines. The priests themselves evolved. Once ritual specialists, they became banker administrators, managing inventories, enforcing contracts, auditing accounts, and advising rulers. Mathematics and writing mattered as much as prayer. Authority flowed from records as much as belief. This fusion of religion and finance created stability. Temples outlasted kings. Dynasties fell. Markets shifted. But temple banking endured because it was embedded in daily life. Farmers relied on seed loans. Merchants relied on silver credit. Cities relied on predictable circulation. Babylon became more than a city. It became a financial hub. Standards spread. Contract formats, interest rates, and accounting practices were copied across the region. What worked in Babylon became a model for others. But power concentrated. Those who controlled lending controlled expansion. Temples influenced which projects advanced and which failed. Infrastructure, trade routes, and political decisions were shaped by access to credit. Finance had become governance. By managing loans, temples managed growth. By enforcing contracts, they enforced order. The priest banker stood at the center of the economy, accountant, judge, strategist. This networked system became the blueprint for future empires. From Assyria to Persia, rulers adopted Babylon's methods. Centuries later, echoes appeared in Greek, Roman, and medieval finance. The world's first banking network was not built by merchants. It was built by priests. And once finance became institutional, civilization could scale beyond local limits. Cities expanded. Trade spanned continents. Economies absorbed shocks. The bankers of Babylon didn't merely support expansion. They made it possible. By Babylon's height, the system was complete. Deposits were standardized. Loans were formalized. Interest was calculated. Contracts were enforced. Records were permanent. Risk was priced. Time was monetized. Every pillar of modern banking already existed, etched into clay. Temples accepted deposits and guaranteed safekeeping. They issued loans backed by contracts. They charged interest based on risk and duration. They enforced repayment through law. They tracked accounts with precision. Nothing about this was accidental. It was engineered. What we call modern finance is ancient at its core. The systems used today, savings, credit, interest rates, collateral, default penalties, were first tested not in glass towers but in mud brick temples. Not by economists, but by priests who understood that belief, order, and records were the strongest currencies of all. And that is the real revelation. Finance did not begin in markets. It did not begin in trade halls. It did not begin with coins. It began in a temple. A place where trust was sacred, authority unquestioned, and records eternal. Where divine fear replaced locks and clay tablets replaced memory. Where surplus met structure and transformed civilization. The bankers of Babylon didn't just manage wealth. They reshaped humanity's relationship with the future. Every loan today echoes their logic. Every interest rate prices time the way they first did. Every contract follows rules pressed into clay over 4,000 years ago. The buildings changed. The gods faded. The system remained. And it still governs our lives. If this story changed how you see money, power, and history, support the channel, like the video, share it with someone who thinks banking is a modern invention, and subscribe to this channel for more untold stories behind the systems that shape our world. Because history doesn't repeat itself, it collects interest. Until next time, remember, the future is financed by the past.